Welcome to Behind the Business, the podcast where we cut through the noise and get real about running a profitable business. I'm Pamela Hilton, CPA, with over 30 years in accounting, tax, payroll, and business advisory services. Each week, I will share stories from the field, answering real questions from business owners, and give you the straight talk you need to grow and protect your business. No fluff, no hype, just practical advice that works in the real world. So, let's get to it. Hello and welcome back to Behind the Business. I'm Pamela Hilton, CPA. In this week's episode, I am busting popular online tax advice that we all see come across our scroll now that we're deep into tax season. The first one I see come across my feed all the time is the Augusta Rule. And if you're not familiar with the Augusta Rule, the intent of this IRS tax rule is that you can rent out your home for your business for up to 14 days, 2 weeks, and collect that rental income, and you don't have to report that income on your tax return. And that's a legitimate IRS rule. But the thing with this Augusta rule, the thing with this rule is that there's a lot of documentation you have to have with this rule. You have to have a lease. You have to have a lot of an audit trail. Like we call that an audit trail. You can't charge above market rent for your property. So you have to have like documentation about what the market rent is in your area for your property. You have to do some research on that. You have to have, documentation in your business minutes about that. And the other thing I want to say is the IRS, the IRS does its due diligence on all of this. It does its research. It's on social media. It knows the hype that's going around on social media about the Augusta Rule. So it's on its radar that people are using this Augusta Rule, that people are using this more. It's a more popular dodge on people's tax returns. And it's under a lot of scrutiny now. So I think a lot of people are being misled about this. Obviously, it's on my podcast now to kind of steer people in a little different direction. And a lot of people ask me about this. A lot of clients ask me about this. And what you cannot do is charge yourself, rent for your business, charge your business charge you rent for your personal house 12 months out of the year and then exclude a couple months rent for under the Augusta Rule, a couple weeks rent for the Augusta Rule, because you've charged yourself rent all year long. That's not the intent of the Augusta Rule, to just exclude some of it under the Augusta Rule, but you've been charging yourself rent all year long. That's not how the Augusta Rule works. It'll send up a huge red flag. You can't have just deducted rent all year long and then just cut out a portion of that for the Augusta Rule, if that makes sense. What CPAs do instead, and you get more bang for your buck, is the home office deduction. It just makes more sense. And so this other social media influencers and tax influencers, as we kind of call them, it's clickbait when they are running these ads for the Augusta Rule. And what they'll do is they'll use the IRS code instead of calling it the Augusta Rule. It's clickbait. And there are other things out there. There are other strategies out there that are just a little more useful. There are better strategies out there than the Augusta Rule for you to use in your business that are just easier to implement than the Augusta Rule. There's a lot, like I said, there's a lot of documentation you have to use for very little tax advantage. Like when it's all said and done, you're gonna save yourself a couple $100 under the Augusta Rule, because after you find out that the market rent in your area is only a couple $100 a day, you know what I mean, for your property, and then you go through the whole process of documenting in your minutes and drawing up a lease to deduct this rent on your business. And you go through all of those motions, and then you're only able to deduct, the tax savings is only a couple $100, when you could just have done the home office deduction, and then the documentation is much less. Come on, let's be real here. What's the better alternative is really the home office deduction. It's kind of obvious. So that's why us CPAs out there, we're not out there
pushing the Augusta Rule because it's obvious the path of least resistance, right? So that's the Augusta Rule. When I see those posts out there pushing a course or pushing some other kind of paid, lead magnet out there to buy this or buy that based on the Augusta Rule, you can just scroll past that because it's probably not worth it. The other one I've been seeing a lot out there that comes across my feed is pay zero taxes. There's a lot of tax influencers out there saying pay zero taxes. Buy my course and I'll show you what the billionaires do, the millionaires out there, how they pay zero taxes. And again, this is clickbait. It's really just not. Is it possible to pay zero taxes? Yes, but it's not really possible for the average W-2. If you work a W-2 job, you're an employee, it's just not possible to pay zero taxes, because when you get a W-2 from an employer, they've already taken the taxes out before you even, they take the taxes out before you get your pay already. It's highly unlikely you're going to pay zero taxes. So it's clickbait. And again, all of those millionaires and billionaires out there, they're still paying some sort of taxes. They pay sales tax, they pay excise tax on the vehicles they buy. They're still paying taxes somewhere along the lines. And even if you're clicking on their pay zero taxes, whatever they're selling, courses, whatever it is, their videos, whatever it is, these things that they're selling, the scenarios that they're setting up are very, very complex. There are things that they're stacking that you would have to set up for yourself to achieve the zero taxes are very, very complex. They would involve setting up businesses or buying rental properties and what we call stacking these things to achieve the strategies that you have to stack one on top of another to achieve the zero taxes. And it's very, very complex, and you need accounting systems, and you need a CPA really to achieve all these things. It's just not possible for the average person. And it's the energy and time involved to set all those things up to pay zero taxes. There's a reason why it's the millionaires and the billionaires and the 1% are able to achieve that. It's because it's a lot of time and energy and money involved to achieve all those things, because it involves corporations and businesses. And you need a CPA to create the corporations and the accounting systems to maintain all of those things. Really, it's not rocket science to create a corporation. Where it heavily involves the labor and the intensity, it's the accounting system and maintaining the books to maintain all those corporations and keep the things running. Is the accounting and the bookkeeping involved in the strategies and the processes involved in those multiple corporations and the strategies on all those things. So if you want to pay zero taxes, there's a lot of things going on behind the scenes within those corporations that are stacked on top of each other, and the strategies within those corporations, you know what I mean? It's like an onion. There's lots of layers going on. So pay zero taxes, those social media posts and videos and reels, again, it's kind of clickbait. There's a lot going on. Can you pay zero taxes? Yes and no. A rabbit hole to go down for the 1%. And if you're the 1%, you already are. You have a CPA to go do that for you. You don't need to click on those anyway. Okay? All right. The third one I see these every so often. I see posts and reels about writing off luxury items. Hey, I just bought this Louis Vuitton bag and I slapped my business logo on it, and I'm going to write off this $20,000 bag in my business. And you can too if you own a business. I'll show you how I did it. Yes, you can do that, but it's also an enormous red flag. So the IRS has this reasonable and necessary test for business deductions, and it's always had this. This is not something new. If you want to write off any kind of business expense, It has to be reasonable and necessary for your business, for your industry. And if you have you need a bag for your business and it's reasonable and necessary for whatever industry you're in, sure, you can write that off as an expense in your business. But does it have to be a $10,000 Louis Vuitton or luxury bag? Probably not. And I tell this to clients all the time. You can write off whatever you want, but is it going to hold up under audit? Is your auditor going to look at that $10,000 deduction and say, nope, you could have bought a $100 bag and it would have served the exact same purpose. You do not need a $10,000 bag to do whatever it is you were carrying. So it has to be reasonable. It has to be necessary. And the bag, the automobile, the house, the boat, the vacations, all of those things, they can't be over the top. They can't be these luxurious, crazy, over the top things. Use your common sense when it comes to the expenses for your business. And, let's be reasonable when you're buying these things for your business. And think like an auditor. I did a podcast on this. Think like an auditor would do. And I have these conversations with clients all the time. Is it going to stand up under audit? Is it, let's be honest here. You're trying to run a business. You don't have to go crazy when it comes to some of these things. And again, the IRS does not live in a bubble. They are on social media. They're seeing what's trending. They know the schemes out there. They have a list of top scams that are going on. So they know what's trending and what's not trending. So when you're seeing these videos out there of these people writing off these luxury items, guess what? You're not the only one seeing these crazy videos. The IRS is also. Next on my list is medical expenses. I've seen some tax influencers out there also kind of touting, you can write off your wellness products. You can write off your spa visits, your spa products as medical expense. You can deduct your medical expenses. And yes and no, that is true. So if you itemize deductions, and this has always been true, this is nothing new, you can write off medical expenses. And in certain cases, health insurance. If you're self-employed, you can write off health insurance. And again, if you're using a CPA, they know this already. Like I said, this is nothing new. Medical expenses have always been, deductible as an itemized deduction. And you can write off eyeglasses, prescriptions, co-pays, things like that. You've always been able to write these things off. But the threshold to write off these things is so incredibly high. I've been doing this. I am in my 36th year in my profession of preparing tax returns, personal returns, business returns. The number of people that itemize, number one, and actually get to write off their medical expenses is so few, because the threshold to, number one, itemize is very little. And the number of people who itemize, who actually get to write off their medical expenses, the threshold is so high, and I'll explain that in a minute, is so few that I tell people, calculate what your medical expenses are. I will let you know what the threshold is, and then you let me know if your medical expenses are that high, and then then you can continue to calculate what they are. So let me just give you an example. If you are married filing joint and you make $150,000 a year, you would need over $11,250 of medical expenses like co-pays, prescription costs, in order to even deduct medical expenses. And then you would need an additional $20,250 of other itemized deductions like real estate taxes, mortgage interest, to even itemize for it to be worth your while. And that's because the threshold for medical expenses, to write off your medical expenses, is 7.5% of your adjusted gross income. And I hate to throw math at you and numbers at you. And then the threshold for the standard deduction to be over, your itemized deductions to be over your standard deduction is 31,500. So there's hurdles you have to get over to even itemize, for your itemized deductions to be over the standard deductions, meaning most people take the standard deduction and they don't even calculate what their medical expenses are, because again, it's the path of least resistance, and it's easier just to take the standard deduction. It's more worth your while. It's very high. The standard deduction rules changed, and it's way easier to take the standard deduction, and it's beneficial for people to take the standard deduction. So that's what most people do. It's the higher number. It's the higher number for most people. So we don't have people go through the pain and effort of calculating medical expenses anymore. So when you see those reels about, hey, you can deduct your beauty stuff, you can deduct your spa, your gym membership. Yep, you can. You absolutely can. But calculating all of that every year, it's clickbait. It's clickbait again, people. All right. So my next list on crazy things you see on the internet is what we call stacking, when you stack entities. And this is a great one for business, for all you businesses out there. It's when you see those reels talking about these tax influencers out there saying that they have instructed clients, their business clients, to create multiple entities so that they're helping their clients take advantage of different entities with different tax rates. So they're stacking the entities and they're shifting income from these different entities to take advantage of different tax rates. We call that stacking the entities. And this is a great strategy, don't get me wrong. It is great, but only if you have a CPA on board who is doing all of the accounting for you, the bookkeeping and accounting, because you need, and I will say this until the day I die, you need accounting systems for all of these, separate bank accounts for all of these entities. You need a solid, you need all of them incorporated solidly. You need accounting systems for them. You need somebody who can manage these accounting systems, because if you're going to do all of these, different entities, and you need more than one, you need to be able to transfer the monies back and forth between these entities, and you need to be able to have separation of all of these things and solid accounting systems to track all of it. And if you are the average business owner, which a majority of my practice is made up of, and I know a majority of everybody else's accounting practices are made up of these business owners, they struggle with their accounting. They struggle with their bookkeeping. And I know this resonates with a lot of people who are listening to my podcast. It's not everybody's strong point. And this tactic, it's not for everybody. And if you are struggling with your bookkeeping and accounting, then you're never going to be able to master this, because it's too hard to even master the accounting for one business entity. If you're going to stack them, you're not going to be able to achieve this. So again, it's a little bit of clickbait, because you have to have solid accounting, not just for one business entity, but for multiple, because you're not only stacking the entity, you're stacking the accounting system, the strategies for multiple entities, because it's not just the accounting, it's the strategy for one, and then you're layering on strategies for two entities, and also not just payroll probably for one entity, but payroll for two, because you have to compensate yourself out of two entities, and then possibly retirement accounts. So you can see how it can get a little squirrely real fast, right? Because it's the mental load for multiple entities, and then sometimes you have a third entity involved. So you can see where that can get a little, it's very, very advanced, and I see I see these reels and videos out there a lot, and it is a good strategy to put in place, but it's really just not for the average business owner out there, because for all the for what I just said. It's really, really, it's an advanced strategy, and it's not for every business owner. Could it be? Yeah, but you have to really, I mean, I struggle in my everyday to just teach the average business owner the importance of having a CPA. And it's something people just don't really want to pay for, to have a CPA on board, but to manage their one business. So take that for what you will. Stacking entities, yes, it can be a very great strategy, but you really have to pay for CPA, and then you have to pay for CPA for multiple businesses. So it's really, you're going to have to shell out thousands of dollars in accounting and tax fees to make that happen. Pluses and minuses, okay? The next one I see all the time is accelerated depreciation. And this one, this one is the epitome of clickbait, because accelerated depreciation has been around forever. It's been around forever and a day, I want to say for as long as I've been a CPA. I'd have to go look that up. But I've been a CPA for 30 years. And accelerated depreciation has been around for a very long time. Let's just say that. And CPAs know and use this every single day. So accelerated depreciation is not something new. So when you see it, your CPA is probably already using it and never even said anything to you. So accelerated depreciation, Section 179, bonus depreciation, it goes under many, many different names, but it's all the same thing, that when you buy a piece of equipment, they're going to just write it off in that year you buy it. It's accelerated. It's nothing new. Your CPA is already using it. So just ignore it if you see it, because your CPA, and even if you are using just a tax preparer, not a CPA, they're probably still using it anyway. So you can just ignore it, because everybody is using it. Moving on. The last one I want to talk about with you today is any kind of, and this doesn't apply just to the tax stuff, any kind of tax or accounting reel or advertising or video that you see that starts with done for you tax, done for you accounting, done for you this, done for you that. Please just walk away, keep scrolling. You don't want done for you tax. You don't want done for you accounting. You don't want it done for you, because it encourages you as a business owner, as a taxpayer, as an individual, for you to disengage from the process. You don't want to be disengaged from the process. And I know when it comes to taxes and accounting, you kind of want to, when it comes to math and accounting, especially if you are a creative, you don't want to be involved, because it's math and it's numbers and it's accounting, and I get it. I work with a lot of creatives, and I get it. And that's why I do what I do. But disengaging from the process, it can be very, very dangerous, because when you disengage from that part of your business, or that part of whatever the taxes, or that part of your business, it can be death for that part of your business when you disengage from the tax part of it or the accounting part of it, because that means you're ignoring it. So when you see done for you tax, you want to be involved in the tax part. You want to know just enough to kind of understand the overview of it, the overall of it. And if you are working with somebody who can explain it to you enough for you to understand it, not enough for you to get that glazed over look, enough for you to kind of keep you engaged enough for you to understand it, and keep you engaged enough for you to kind of get an overall understanding of it, perfect. Because it's really, really important. This is your money. This is what's keeping you afloat. The name of the game is to save you money in taxes. It's to build your wealth. It's to pay as little in taxes as possible every single year, and to know how much you're paying before we get to the end of the year. So anything that's doing it all for you and keeping you disengaged is very, very bad for you personally and business-wise. If it's going to put up a wall and kind of keep you in the dark, it's just bad for business. And that's kind of opposite of what I've been doing my whole career. What we do at Hilton CPA is we're very transparent about what we're doing for you personally and business-wise when it comes to your taxes, your business, your accounting, the bookkeeping, the payroll, all of it. We try to keep you as involved as humanly possible. And even if you don't want to be involved, we're still like giving you access to all of the reports, whether you want it or not. So any kind of, like I said, video that starts with done for you, I would dig a little deeper, I guess, be a little more apprehensive of, because you don't want to be disengaged from the whole process. You want to be involved, especially if you're a business owner, because you have to be involved in every single part of the process, because you're the boss. You need to know what's going on in every single aspect of the processes and the procedures so that you can make the decisions for the business and lead it. You're the leader. You're steering the ship. So finally, take the time, if you got anything out of all of these things that I'm saying about all of these videos, and be just weary of what you're seeing online, take the time to find the right CPA and advisor who will start at the foundation of your business, which is the books, the numbers. That's where it all starts. And if you're watching any of my other podcasts, you know, it all starts with the numbers, the bottom, the foundation. And then from there, it starts with the strategy, the business strategy, the tax strategy. Because like I said, that's the name of the game throughout all of this, is to save you money in taxes, to save you money in the profits and all of that. Forget the DIY stuff, forget the DIY bookkeeping, forget the DIY tax prep. A good CPA and CPA advisor will save you more money in taxes than what you're paying in their fees. So if you're a business owner and you like what you heard and any of this resonated with you with these online tax myths, save this podcast, send it to another business owner. It might save them a lot of heartache this tax season. Until next time, Pamela Hilton, CPA, and share this podcast with a friend.
Thanks for listening to Behind the Business. If you found this episode helpful, please share it with another business owner who could use some real-world advice. For free resources, tools, and to submit your own business questions, head on over to my website, PamelaHiltonCPA.com. Until next time, keep building smart and keep looking behind the business.